Welcome, everyone. This is Ed McGill, co-founder and partner of McGill Jungie Wealth Management. And today I'm being joined by fellow co-founder and partner Ross Jungie and Jason Kirchhoff, our director of investments here at McGill Jungie Wealth Management. So welcome.
Thank you.
So this is going to be a new segment we're going to be doing quarterly. Jason writes our quarterly commentary, and then that will drop via LinkedIn and other sources to our clients. But Jason, let's start with you on why we do the market commentary. Why is it striving to be different? And then after that, because this is April 9th and a lot of interesting things going on in the markets, we will shift gears a little bit just to talk specifically about what's happening. But let's start with the market commentary.
Yeah, thanks, Ed. Maybe I'll start with why it's different. You can find a lot of quarterly commentary pieces that highlight what has happened in the past few months, what was up, what was down. That can be helpful, but a lot of times that's more noise, right? There's no action item out of that. There's no long-term thinking. Our idea was to try and connect the dots. We do a lot of reading in the investment department. We read investment commentary, market commentary, academic research. We come across a lot of different pieces, and what we're trying to do is when we see things that have connections, highlight that to our clients. It's also meant to be very brief because we know at the end of the day, time is everybody's biggest resource. So we want to be very mindful of that. But maybe just to kind of take a step back on this quarter to highlight how we connected dots. It started with reading quite a bit about decision-making during risk and uncertainty. And there's an author by the name of Gerd Gigerenzer who writes a lot about
nice
using
job on
rules.
that one.
Yeah, well, I probably didn't do it right. So, but he writes a lot about using rules of thumb and not adding just more data doesn't necessarily mean you're going to make a better decision. And in this one book I was reading, he was highlighting after 9/11, a lot of people started driving rather than flying due to that headline risk. And he highlighted that if you drive more than 7 miles, you're actually increasing your mortality risk. At the same time as we were reading that, there was an academic paper that tried to quantify your odds of losing money after inflation over very long periods of time, 30-year periods. And they did it in a kind of a unique way to try and remove some of the biases if you just look at the US markets. And what they found was, probably not surprisingly, that the risk of staying in cash over 30-year periods, you're highly likely to lose money after inflation. Versus a globally diversified portfolio. So with those two pieces, those two dots, we try to connect them, highlighting that, headlines can make you rethink risk, but it shouldn't necessarily impact your decisions.
Well, and that's awesome. And I think there always will be a general theme on these. And they are going to be dropped quarterly in a number of venues, and people can sign up for that quarterly commentary. So we suggest that you do that. Jason has a great way of thinking and then putting some complex terms into easy to read, quick hitters in there too. So thank you for doing that, Jason. Look forward to the other ones coming up this year. Now, Ross, you spent 20 plus years in the institutional investment world. Actually, were chief investment officer managing about you and your team, $55 billion. And now you've been here 11 plus years at McGill Jungie. So you've seen some of these downturns or this market volatility. Just what are your thoughts, right now as you see what's going on?
Well, first of all, thanks for reminding me how old I am, and thinking back to the global financial crisis and obviously a lot of other more volatile times in the markets. But I think first stating the obvious, the tariff tantrum has created the spark to the system that's increased growing uncertainty, heightened capital market risk premiums, growing fears of recession. Stocks are firmly in correction territory as we record this, down anywhere from 15 to 20%, depending on the hour, depending on the minute. But there's the key thing is there's no reason to panic. We're not even back to year-end 2023 levels yet. It may feel like the sky's falling, the world's coming to an end, but it's not. Take a deep breath, delete your social media apps if you have to, if that helps you. But the typical measures of risk we are starting to see are pricing in the higher levels of uncertainty that we're currently in the economic and investment landscape. Credit spreads are widening. The VIX index, which is a measure of short-term implied volatility on the S&P 500 has, recently spiked from the 15 to 20 range, where it's basically implying almost no volatility, which is what we saw during 23 and 24, to levels that have recently hit, 49, 50, 51. That's implying basically a 2 to 2.5% daily move in the S&P 500, which longer term won't be sustained, but based on the heightened uncertainty right now, is consistent with the markets. But volatility like this are not unusual, and they are expected and create opportunities really for the strong hands to earn the excess returns of owning equities long term, while the weak hands sell and do the wrong thing at the wrong time. And it's really the stock market, this old saying that the stock market is a mechanism for transferring wealth from the impatient to the patient. I love that saying, and it definitely is true during times like this, to reflect back on things like that. I also think it helps to take a step back and look at the bigger picture over the last, to put things in perspective. We just came off back-to-back, 20+% return years on the S&P 500, and the best 15-year historical time period we've seen for U.S. stocks. Inter-year market declines like this are not abnormal at all. They average about 14% per year. And 3/4 of those years, over the last 45 years, the market still finishes in positive territory. And if you think about where we've been over the last 5 years, we've survived a global pandemic. We've managed through 0 interest rates to 5% plus interest rates, back to 4. We went from non-existent inflation to upper single digits inflation, back to 3%. And we survived double-digit negative returns in 2022 for both equities and bonds. I tend to be more of a glasses half full person and view of the world, and we will manage through this. The U.S. economy and businesses are very resilient, or they're innovative. We'll find a new foundation for future growth as we work through this. And I think also it's good to recognize for all of our listeners that heightened uncertainty and volatile market conditions can be emotionally challenging to get through. I think it's a natural thing for some people than others. But times like this are good reminders why you work with a team like ours that is focused on comprehensive financial planning, integrated investments, and not getting lulled to sleep by times like the last couple of years where there was very little volatility. And some people can tend to forget about the importance of true diversification, building resilient portfolios.
Now that makes a lot of sense, and I hope everyone picked up on when Ross said the intra-year decline. That doesn't mean where the market ended up, but during the course of the year that the average decline at some point is 14%. And so that's always important to realize that. Jason, when you think about just, whether it be tariffs that you wanted to mention about, or just even some of the things earlier in the year, but then also what are some of the things that our team has been doing to try to take advantage of some of this fluctuation? So maybe kind of group those together for you.
Yeah. To Ross's point, the volatility has been on the extreme end, and seeing some bizarre things in the short term. For example, I saw the Chinese embassy tweeted out a Reagan speech on tariffs when Reagan was talking about how bad tariffs were. If somebody had offered me a wager on the Chinese embassy tweeting out Reagan speeches, I think I would have lost that bet. But with the volatility, it does create some opportunities. We're not making big shifts or anything, but there's opportunities to harvest tax losses, which we are doing. And we are looking at potentially doing some rebalancing. But I think the better question, Ed, and not that was a bad question, but the better question is, what did we do over the prior year to make portfolios more resilient? What did we do in preparation? Not that we knew this was coming, but these types of events occur.
That is a better question, by the way. So we'll let you riff on that.
Glad you agree with that. I would say, when we think about some of the changes we made to the portfolios over the past 18 months, For example, removing China from our emerging markets exposure. That wasn't done because we thought the potential returns on Chinese equities was going to be poor. In fact, they've done really well as of late. It was more about the risk. That's the one thing we can control from a portfolio standpoint is the risk we're taking. And we didn't think we were getting paid necessarily to take on that risk. And given recent events, I would say that conviction level has probably increased. And not that we're, once again, not that we're predicting doom and gloom for Chinese equities, but I would say if you look at history, trade wars turn into capital wars pretty quickly. And while other countries seem to be willing to negotiate, the tit for tat with China seems to be escalating. Some of the other things we've done, we added some trend following strategies to most portfolios. These are liquid strategies that have the ability to go short different markets. And we think they do well in periods of chaos. So if this were to continue, there's something in the portfolio that has the potential to do much better than everything else. And then I would just kind of point to our ability or desire to maintain broad geographic diversification. So it wasn't always a fun story over the past couple of years talking about international stocks, because obviously a very simple U.S. large cap focused portfolio had done the best. And it's obviously short term, but we're starting to see diversification pay off again.
No, and I appreciate that and the thoughtfulness and the whole piece with the tax loss harvesting. I think back to when COVID happened and we actually rebalanced and tax loss harvested a couple of times throughout that year, and were able to capture some losses after the March, significant downturn. And even though the markets ended up positive for the year, we had created those losses that then could be used to offset, gains either that year or future years. And so that's what we mean by harvesting, those tax losses on that side. And Ross, maybe to let you end it, just any final words or thoughts, for our clients as we wrap up this little mini quarterly podcast.
Well, I think, one thing just to build on, Jason's comments on opportunities, this isn't the time to, try to be a hero and push all your chips in and make, big changes to whether it's portfolios or whatever it is that you're doing. But I think you're starting to be paid better to take risk. That's what happens when volatility happens. And, you reflect back on, Warren Buffett's famous quote, "Be greedy when others are fearful and fearful when others are greedy." And, this is a time to, phase in excess cash. If you've been sitting on some, take advantage of better buying opportunities. And I think also just making sure that people understand that, we and our clients do understand this, that it's not just investments working by themselves. It's the importance of that being integrated with financial planning, integrated with, risk-based products like permanent cash value life insurance, income annuities, et cetera, that help provide
cash on hand,
guaranteed streams of income, cash on hand, that foundation that allows people to ride through volatile environments like this and understand that, the lifeboat drill that we run for clients, all of those things provide peace of mind to avoid making the wrong decision at the wrong time, but stick with your plan because your plan was built to withstand an environment like this. If you're going to do Roth conversions in a typical year, this is a good time to think about taking advantage of that. You can convert your pre-tax into Roth at lower income or more shares for the same income, and ultimately, ride the higher expected returns in your tax-free forever Roth account. So, the last few things I would just suggest is trust your plan, lean on your advisor, let us do the worrying for you. Don't put that all on your shoulders. Avoid those emotionally driven decisions, and don't listen to the talking heads, especially those that are at the extremes, whether they're extreme over here or over there. Most of the time they're wrong. Somewhere in between is what's going to ultimately be turn out to be the truth. And last thing, just think about why you own equities in a long-term diversified portfolio. It's the price. This type of volatility is the price of admission to earn those higher rates of return longer term, and keep the right long-term, maintain the right long-term perspective. These short-term time frames and bouts of volatility, et cetera, are going to be there, and they're going to be here again in 3 years, 5 years for probably a different reason. We have to, we're prepared for those. Your plans are prepared for those, and great investors. To Jason's point, great investors don't predict crisis; they prepare for them. And that's what we do for our clients with the way we build resilient portfolios and the way that we integrate investments with comprehensive financial plans.
Well, I love how you ended that. And for clarity, the lifeboat drill, for people that heard that, where we've been on cruises before where they make you go stand out there on the ledge and learn where the lifeboat is. The lifeboat drill for our team is just rerunning your plan, assuming the market decreases even significantly further, so that we can show people the peace of mind that the plans are resilient, the portfolios are resilient, and definitely the McGill-Junge team is resilient and working on your behalf. So with that, this is Ed McGill signing off for Ross Junge, Jason Kirchhoff, and the entire McGill-Junge team. Thank you for joining, and feel free to reach out to us or your advisor here on the team at any time. We're here for you. Have a great day.